The Paul Merriman Ultimate Buy and Hold portfolio specifies very specific market segments based on historical outperformance and different sources of risk. Here we'll take a look at its components, performance, and the best ETFs to use in its construction. So first, who is Paul Merriman? Paul Merriman is a financial advisor and educator who is extremely popular in the financial blogosphere for his assessments on index investing and asset allocation in relation to long-term buy and hold investing strategies. Merriman founded an investment advisory firm in Seattle in 1983, from which he has since retired. He is regularly published on MarketWatch.com and offers free podcasts, articles, newsletters, and more on his website paulmerriman.com. Merriman has written a number of highly rated books that you can find on Amazon. His newest one from November 2020 is We're Talking Millions: 12 Simple Ways to Supercharge Your Retirement. He also designed the Paul Merriman 4-Fund portfolio. So what is the Ultimate Buy and Hold portfolio? As the name suggests, this is a lazy portfolio designed by Paul Merriman for the ultimate buy and hold investing strategy. It probably has the longest name of all the lazy portfolios, but that's okay with me. To design the portfolio, Merriman looked historically at the very specific market segments that had the greatest and most consistent historical outperformance across stocks of all cap sizes globally. Specifically, he maintains that the term ultimate must describe a portfolio that has consistently outperformed the S&P 500 with no additional risk. Merriman himself updates the performance of the ultimate buy and hold portfolio annually and occasionally swaps out his best-in-class ETF recommendations based on tracking, factor exposure, and fees. He is constantly attempting to further optimize the portfolio at the margin. I can get behind that. Consistent with investing wisdom of a 60-40 portfolio being the center of gravity between risk and return, the ultimate buy and hold portfolio allocates 60% to stocks and 40% to bonds. As I've covered before, this provides long-term growth from stocks combined with volatility and risk reduction from bonds. However, Merriman acknowledges that this asset allocation may not be appropriate for everyone and suggests that investors should choose their own allocation based on their own personal risk tolerance. I discussed how to do that in a separate video here. Now let's look at the specific asset choices. The bond side of the ultimate buy and hold portfolio is easier to cover than the stock side. Merriman advocates for strictly using treasury bonds over corporate bonds. I agree with this wholeheartedly. He specifically suggests using 50% intermediate term treasury bonds, 30% short-term treasury bonds, and 20% inflation-protected bonds, also known as TIPS. I personally feel the average bond duration of these allocations is much too conservative for most investors, and that investors should aim to roughly match bond duration to their investing horizon, but for the sake of the discussion here, I'm going to leave Merriman's recommendations unchanged. Again, he suggests that a 60-40 allocation may not be appropriate for everyone. Merriman explicitly acknowledges that the ultimate buy and hold strategy takes calculated risks in stocks while being very conservative on the bond side. It keeps 12% of the total portfolio in short-term bonds, considered a cash equivalent. The equity side of the Merriman Ultimate Buy and Hold portfolio is much more complex and nuanced. Merriman walks us through these steps of construction. Start with a basis of large-cap US stocks accessible via the S&P 500 index. Secondly, diversify with REITs, as they have historically had a low correlation to the stock market. Small stocks have historically outperformed large stocks, so small caps are overweighted. This is known as the size premium. And then value stocks, companies that are believed to be underpriced, have historically outperformed growth stocks. This is known as the value premium. A truly diversified equities portfolio must incorporate international stocks, so half of the equity side is put in international stocks, again specifically overweighting small cap and value stocks as well as emerging markets. My own portfolio draws heavily from the analysis and recommendations by Merriman, specifically as it relates to tilting toward the size and value factor premia and overweighting emerging markets. Combining all these steps, the Paul Merriman Ultimate Buy and Hold portfolio asset allocation is as follows: 6% total US stock market, 6% US large cap value, 6% US small cap stocks, 6% US small cap value, 6% US REITs, 6% international developed market stocks, 6% international value, 6% international small cap stocks, 6% international small cap value, 6% emerging market stocks, 12% short-term treasury bonds, 20% intermediate term treasury bonds, and 8% TIPS. Using live fund data going back to 1999, here's the Ultimate Buy and Hold portfolio's performance versus a traditional 60-40 portfolio using intermediate treasuries and the S&P 500 index through 2022. Over that time period, the Merriman Ultimate Buy and Hold portfolio has delivered a slightly higher return with similar risk metrics to a traditional 60-40. Notice how its volatility was roughly 1/3 less than that of the S&P 500, and its max drawdown was much smaller. Looking at the 5-year rolling returns, we can see how the UB&H portfolio's factor exposure and international diversification shined in the early 2000s 2000s and suffered during the latter years of the backtest. Here are the results from 1970 from Merriman's website corresponding to each step of the portfolio's construction. Now let's talk about how to build this portfolio using Merriman's best-in-class ETFs. I think M1 Finance is a great choice of broker to implement the ultimate buy and hold portfolio because it makes regular rebalancing seamless and easy, has zero transaction fees, and incorporates dynamic rebalancing for new deposits. I wrote a comprehensive review of the platform that I've got a link for in the description. Merriman's best-in-class ETF recommendations rely heavily on fund offerings from Avantis, a relatively new ETF provider founded by former Dimensional employees. The important takeaway is that we would expect Avantis funds to provide reliable factor targeting, and indeed they have in their short lifespans thus far. We can construct the ultimate buy and hold portfolio like this: AVUS at 6%, RPV at 6%, IJR at 6%, AVUV at 6%, VNQ at 6%, AVDE at 6%, DFIV at 6%, FNDC at 6%, AVDV at 6%, AVEM at 6%, VGSH at 12%, SPTI at 20%, and VTIP at 8%. I'll include a link in the description to invest in this portfolio. If you're like me, you might want to use a one-size-fits-most 80-20 allocation instead of 60-40 and just use long-term treasury bonds on the fixed income side. Using the same backtest earlier, I've added my modified version as UBH 80-20. Note that the colors here may be different from the earlier backtest. The 80-20 would have yielded a higher return with a slightly lower risk-adjusted return. This 80-20 modified ultimate buy and hold portfolio then becomes AVUS at 8%, RPV at 8%, IJR at 8%, AVUV at 8%, VNQ at 8%, AVDE at 8%, DFIV at 8%, FNDC at 8%, AVDV at 8%, AVEM at 8%, and VGLT at 20%. I'll include a link for this portfolio in the description as well. Lastly, let's briefly talk about an aggressive ultimate buy and hold portfolio using 100% stocks. Young investors with a long time horizon and or a high tolerance for risk may desire to go 100% stocks and 0 bonds. Removing the bonds knocks it down to 10 funds. This one is actually sometimes specifically referred to as the Paul Merriman 10 fund portfolio. Here's what that would look like. It's essentially just 10 funds at equal weights with 10% each. AVUS at 10%, RPV at 10%, IJR at 10%, AVUV at 10%, VNQ at 10%, AVDE at 10%, DFIV at 10%, FNDC at 10%, AVDV at 10%, and AVEM at 10%. And in the interest of full disclosure, here's the backtest for this aggressive version versus the original 60-40 version and the S&P 500. As we would expect, this aggressive 100% stocks version of the ultimate buy and hold portfolio beat the S&P 500 on both a general and risk-adjusted basis. But note that it had a lower risk-adjusted return than the UB&H versions, including bonds. I'll include a link in the description for this portfolio as well. If you enjoyed this video, be sure to check out my breakdowns of other lazy portfolios here. What do you think of Merriman's ultimate buy and hold portfolio? Let me know in the comments. Thanks for watching. I am long AVUV and AVDV in my own portfolio.